countries that meet together and decide things together. The outcome of this is the tax treaty web that we all know. Then we have a slightly more innovative concept, which is the transgovernmental cooperation, which involves the subunits of the government. So all the agencies of the government and the treasury and revenues, they form these transgovernmental nets. And then we have transnational cooperation, which includes, it's a more enlarged way to see cooperation between countries, and includes all the non-state actors, including the NGOs, for example, and every actor which is independent from the state. And these can be called epistemic communities, and in a way they operate in a parallel way, both internally between them, so because they have this structure of a net inside them, and externally because they are often connected to each other. And this creates our epistemic nets. And just plural constitutionalism instead can be defined as a web of governments which act in a hierarchy. So this is the most notable example of this is the European Union. The European Union is based on the fact that there are various sites of authority which are involved in a creation of norms, but they are all at the same level. There is no a ranked organization, and they have a common ground of legitimacy, a common grammar of legitimacy to understand, to take decisions and to make decisions and understand each other. The local connections involve all these last three elements that we mentioned. So transgovernmental nets, the revenues, epistemic nets, which are the non-state actors, and plural constitutionalism, which is a way to interact with each other. And this creates these local connections because they can enlarge the way decisions are made, passing from bilateralism to multilateralism. That is something that is slowly happening, but not as fast as we wish. Therefore, what we need are multiple actors, so governments, transgovernmental nets, and epistemic nets, connections among these nodes, and information that can flow around. So any kind of information that flows from one node to another is what we are looking for. And this creates a regulatory framework for tax competition that is enlarged and does not involve anymore only direct decision from a state which has its own interests, but a governance system of interconnected nodes. Therefore, we include the interactions between states and states, states and non-state actors, and non-state actors, which is very important according to our opinion. This creates two ways of making decisions, with the traditional way that leads to the formal agreements, and the local network relationships, which includes all our broader factors. I will skip this, I'm sorry, just to be on. So we wish to have the establishment of a new network, of a new tax governance, a new order, which is complementary to the existing one. So what we wish to have is governments, tax courts, tax administration, and non-state actors to act together and to involve and to create connections between them, and to cooperate on specific functions as taxes. So the research question is basically, if these transgovernmental nets, epistemic nets, and plural constitutionalism can help to solve the problem of harmful tax competition. So we saw from our experience, our very recent experience, that the OECD, which includes 3 different networks, has to some extent brought transgovernmentalism. In particular, we have the OECD Council, the Center for Tax Policy Administration, and the CFA, the Committee on Fiscal Affairs. The Council has an hybrid structure, so it's both a hierarchy and the network. But the CTPA, it's what we can define a transgovernmental net. So tax administration come together and make decisions together. The CFA is even more interesting because it creates a transgovernmental network, but at the same time, it brings together not only tax officials, but also experts from member and observer countries of the OECD, which is something that we really appreciated. And these tax policy groups, basically the CFA, can be defined also as an epistemic community to some extent. I will skip the G20, although I'll just tell you that it has these very important functions as well, like syndicating, endorsing, and make orchestration of the policies. So the most important thing is to legitimize policies that are created by those transgovernmental nets. And so what transgovernmentalism can bring is the collaboration in an entity such as the CTPA, but it doesn't have necessarily to be the OECD, of course. But what we would like to see is to have a connection with the NGOs and with the other non-state actors in order to have vehicles of ideas that affect tax outcomes. This can be operated, so epistemic nets can operate together with transgovernmental nets, as we saw, and this will bring to a very important outcome, which is localization in tax policy. So basically having, at a global level, the ideas on what we want to reach, which is organized through the governments and the transgovernmental nets, but at the same time, have the idea on how to implement that at a local level. So basically, the adaptation of what the policy is to specific cultures. So both global and local level of tax policy. And also, we wondered about the networked plural constitutionalism and its role in the elaboration of, in addressing harmful tax competition. And in this case, we saw the example of the European Union as the main one. As the European Union creating this idea of tax dumping, which they realize being negative for themselves. So the European Union stated that tax dumping is negative and that they wanted to address this issue. Therefore, one of the basic ideas in plural constitutionalism is that we have to substitute tax harmonization with tax coordination, which is basically more effective. And this creates advantageous solutions. If we look at what the EU has done, they basically go through 3 dimensions. Intra-EU, so among states, how states operate with each other. EU inbound, so EU vis-a-vis what are the other non-EU investors that are coming in the EU, and the EU outbound policies. And as we saw, one of the main examples is that the intra-EU dimension was very important, and it solved several problems of tax avoidance being coordinating all together. And one of the main examples is basically ATAD, in which we have, thanks to this defensive coalition, we have the introduction in all the European Union member countries of interest limitation rules, exit taxes, and general anti-abuse rules. Just to conclude, another idea that the EU is approaching is CCCTB, which probably is the best coordinated EU approach that they could think of. And therefore, our idea is that looking at the EU as plural constitutionalism, we believe that this system can be adopted elsewhere, and that it can be very effective in defending against this problem of harmful tax competition. Thank you all very much for your attention.
Can I suggest that you keep your thoughts and you use Slido, and we go to at least the first.
Okay, so I'm looking at my paper at the enablers of corporate tax evasion specifically. And I began my research with quite a broad question, which is why do we have such a dysfunctional global tax governance system that allows multinational corporations to get away without paying so much tax? And why is there this disjunct between where multinational corporations do business and where do they pay tax? And why have the reform programs so far failed to adequately address this problem, even to the point where it seems to be getting worse? There's been international outrage with the cases exposed by things like the Paradise Papers and the Panama Papers, for example, like this example of Nike and how it's shifting profits from all its sales from Europe and the Middle East and Africa into Netherlands and then through to Bermuda, which is a zero corporate tax jurisdiction. Let's see. Can you still hear me if it's here? Okay. So the institutional inertia that I'm looking at is the rules that were set up by the League of Nations in the 1920s have basically been left unchanged. So we've got at the core of global governance something that was established 100 years ago and hasn't been adapted to the realities of globalized trade. So I'm looking here at things like the bilateral double taxation treaties, the principle of separate entity accounting, and arm's length pricing rules to try to bridge the gap and make sure that we then reach unitary taxation. This system has been justified because it's supposed to mitigate double taxation and it's supposed to avoid the infringement of sovereignty and how states deal with their share of the transnational tax base. But however, we're obviously all well aware of the results of these rules in terms of enabling multinationals to avoid tax through profit shifting, eroding the tax base of countries around the world, and fostering tax competition between states. So what we see with global tax governance is something like a regulatory game of cat and mouse. Instead of fundamentally reforming the core rules, organizations like the OECD and the EU have engaged in rule layering. So it's trying to close loopholes by creating ever more complex layers of rules, which in turn create more loopholes. So this just enables the tax planning industry to engage in what we call creative compliance. And the OECD has basically admitted that with regards to regulating transfer pricing through arm's length pricing rules, identifying those comparable market prices is in most cases difficult or impossible. So they admit that this doesn't work. So what we see is increasing elaboration and complexity of tax rules that hasn't closed the gap between where multinationals do business and where they pay tax. So my paper tries to explain why these reform programs, which these organizations have been embarking on for several decades, have been so ineffective and why corporate tax evasion is still such a big problem. So first I'll outline my theoretical understanding of the institutional framework of global tax governance, and then I'll present my analysis of how multinational corporations and the tax planning industry have been able to channel and delay reforms to the global tax system and the types of power at their disposal. And finally, I'll examine what this means for the reform movement being led by civil society actors like the Tax Justice Network. So I see global tax governance as an arena of contestation involving a constellation of actors in which ideas, knowledge, and discourses play a crucial role in countervailing processes of resistance and reaction. I found in my research that the theories of like rational choice and path dependency that are typical for historical institutionalism were not really that satisfying. They don't really provide a full picture of internal processes of endogenous change that can shape the institutional change over time. And I think it's also important not to see states as like unitary rational actors with a straightforward set of interests. Obviously, states have gained different advantages from the way in which they engage with global tax governance, but it serves narrow interests of different people, and I don't think we can just take states as unitary actors. So the way I came to think about it was that this stability and continuity at the heart of global tax governance is not something that's automatic and self-perpetuating and self-reinforcing, but rather it's like the result of the mobilization of multinational corporations and the tax planning industry to shape how states understand their interests, values, and identities. So this is where they have the power to channel and delay reform. And to explain these dynamics, I've borrowed Carstensen and Smith's taxonomy of 3 different types of ideational power. So the ideational power, I feel like, is one element. Material power is another one. We've spoken over the last 2 days quite a lot about the imbalance of material power between, say, tax collection agencies as opposed to accountancy firms, which have vast resources, as well as legal firms. But I think the power of ideas is something which we really need to take quite seriously. So there's 3 types of power: power over ideas, power in and through ideas, and power over ideas. So I'll just quickly explain what these terms mean. So power in ideas takes place through the establishing of hegemony or institutions imposing constraints on what ideas are considered. This refers to the background processes that affect which ideas are considered viable and reasonable, while others are too extreme or unrealistic. And these background processes form deeper level ideational and institutional structures that produce and constitute actors' self-understandings, identity, and perceived interests. And this can include ideas that are taken for granted, that are depoliticized, unexamined, and even forgotten about. Power through ideas is understood as the capacity of actors to persuade other actors to accept and adopt their views through the use of ideational elements. Persuasion can be both a top-down and a bottom-up process, as actors draw on cognitive and normative frameworks to give meaning to their material and social circumstances and affect what ideas and discourses are deemed viable. And finally, power over ideas is the imposition of ideas and the power to resist the inclusion of alternative ideas into the policy-making arena. This power may come about as a result of the formation of epistemic communities, such as a group of technocratic experts with a shared outlook, able to harness enough legitimacy around their policy ideas to avoid considering alternative approaches or disregard them as untenable or not even qualified for discussion. So how do we see these types of ideational power playing out in global tax governance? I would argue that firstly, multinational corporations and the tax planning industry have really cleverly manipulated states' understanding of themselves as liberal, market-friendly, sovereign states, and this is the power in and through ideas. And secondly, the tax planning industry's embeddedness in a technocratic epistemic community of tax experts and their privileged and unchallenged status as a source of independent expertise has enabled them to use various channels of influence within policy-making and regulatory spheres. And I argue that this power over ideas has enabled them to promote the interests of corporate capital and dismiss or ignore reform ideas that would challenge the core principles of the institutional framework. So liberal economic theory provides the norms, cognitive frames, and meaning systems within which states come to act and understand the world. And MNCs, multinational corporations in the tax planning industry have used this knowledge and consistently drawn on this liberal economic theory as a normative and cognitive ideational framework to lobby for their own interests. For example, they often choose to frame taxation as a cost rather than a transfer within the economy, and present information which seems to suggest that higher tax rates equals lower GDP growth. They also frame tax competition as a healthy dynamic which restrains excessive taxation, and propose that tax competition will exert market discipline over states that are being too greedy and trying to tax too much. So they bring this sort of like negative framing of tax as a cost rather than a benefit to society overall. And disregard the economic necessity of taxation as like an essential part of the compact between states and the corporation. You can see this in action when the OECD launched the harmful tax competition program in the 1990s. The whole program eventually reversed course after the massive mobilization of groups like the Heritage Foundation, it came out in support of tax competition as a healthy dynamic, so it completely changed what it was originally set out to do. groups like the Institute for Economic Affairs here in the UK even have the goal to frame tax havens as playing a vital role in ensuring the free flow of international capital. And also when tax havens have been targeted, these small states, rather than looking at tax havens in a more systemic way, but the small states that have been targeted have been forced to sign tax information exchange agreements, which is also, you can kind of interpret as in line with liberal economic theory because it blames market malfunctions on information asymmetries. So this going this far to institute more information sharing basically means that government regulation might not be needed because all you need is to improve the availability and dissemination of information. On the side of sovereignty and the power in ideas of sovereignty, what we see with the representation of sovereignty as a notion is that there's this kind of paradoxical and one-sided way that the tax planning industry describes it. So they focus on how the current tax governance model defends the de jure sovereignty of nations, which is the legal right to design their own tax systems. But they ignore the fact that this completely undermines the kind of de facto sovereignty of a state in being able to attain their substantive policy goals of efficiency and equity through taxation. So in this regard, we can see sovereignty more being like a cognitive script, and also there's a mobilization of nationalism and this concept to sort of win states over. And you can see this like very much in action, especially from the US. They've taken very aggressive action over the years to sort of shift tax governance out of forums that are more democratic, like the UN, and bring it into forums like the OECD, where perhaps they have more power. And I think that this sort of like notion of sovereignty is something that's worth paying attention to. And yeah, finally, I think the power over ideas, the notion of having an epistemic community, we've discussed at great length. Sol also talked about it last night, so I won't go into it in too much detail now, but I think that this dynamic of technical complexity in global taxation governments has given rise to a situation of regulatory capture where policy making and rule interpretation is deeply influenced by the tax planning industry. So I think the net result of these phenomena is basically the institutionalization of the core principles of global tax governance by the virtue of their consistent and protracted use by an epistemic community of bureaucrats, regulators, lawyers, and they've come to form the taken for granted, unquestioned, legitimate basis for policy making and legal decision making. Under those conditions, people, and I think some people in this room have experienced this themselves, those who question the foundations of global taxation governance run the risk of being considered too radical and unrealistic and even finding themselves socially and professionally isolated. As for where this leaves the Tax Justice Network and other civil society groups, they've had to spend a lot of time and resources doing definitional work to recast the meanings of these cultural categories that have been so deeply entrenched in policymaking circles and the general public at large. And I would say that, maybe to summarize very quickly, it's important that we keep talking about justice. It's obviously where the Tax Justice Network and other groups can steal the march on the tax planning industry. But I think it's also too important to keep reframing these notions of sovereignty and liberal economic theory in our own terms. And I think the Tax Justice Network have done a great job of, for example, rejecting the notion of tax competition and framing it as tax wars because of the damage that these dynamics do. And maybe we need to tell a different story about the proper relationship between the corporation and the state and recognize that the two together, they're like formed over their history in partnership with one another. Liberal corporate capitalism has emerged as a mode of liberal government, helping the state to provide for the health, welfare, and security of the population, and one cannot survive without the other. Yeah, that's it. If you're interested in where I got the images from for this presentation, just a shameless plug of my own work, I've turned the findings from my dissertation into a comic, which I published on the Nib with the help of a really talented artist called Erlend from Norway. I'm now working with the Tax Justice Network to turn this into an animated video, so I'll keep you all posted when that's published.
Okay, from a multi-talented Saskia to Kumiko.
Thank you, Charles, and thank you, Tax Justice Network, and everyone here for having me here. So I'm Kumiko Tsuda, a PhD student from Japan, and my research I'm presenting is to explore the role of Keidanren, that is the biggest business groups in Japan, and the role on the negotiation process of the OECD's BEPS project. And the starting point of my research question is the general recognition of the Japanese less motivated to aggressive tax planning. Believe it or not, there are those recognition even in among Japanese business. So nevertheless, the lobby by Japanese business was indeed aggressive. And their most concern was expressed on the country-by-country reporting, CBCR. And it is, CBCR, as you all know, is the idea for further tax transparency to unveil suspicious, harmful tax avoidance activities. To this idea, it is well known that the business groups and accountancy firms across the world strongly opposed. And so did Japanese business. Why? So this research investigates why and how Japanese business, which perceived less motivated to aggressive tax planning, intensively involved in the BEPS negotiations. And this analytical approach has some limitations, such that it cannot verify to what extent Japanese business successfully affected to the process, but at least this research will contribute to unveil how Japan and Japanese business, which tends to be neglected in research on international tax avoidance, played and performed in the policy process of the BEPS, and what their interests and concerns are. So here is the research design given in my full paper. Due to the limitation of time, I will focus on the latter half, underlined here. Okay, too many animations. Sorry about that. So in the Keidanren's lobby formation, their think tank called the 21st Century Public Policy Institute played a central role. And there are several aspects, but the most noteworthy part must be its constituent members of the research group on international taxation established within the think tank. And the members were not only from multinationals affiliated to Keidanren, but also from Big Four accountancy firms and from universities, mainly professors of tax law. Their research directly contributed to construct Keidanren's opinions, and it appeared anywhere else in Keidanren's stance, such as their comments to the draft discussion papers of the BEPS project. So, business groups and accounting firms strongly opposed to the CBCR generally because of the cost and the risks to disclose their confidential information, and Japanese multinationals were basically being in line with it. But additionally, there was another concern, slightly different from other Western counterparts. That is, the issues related in emerging markets, more specifically in China, where Japanese companies are more based in than Western companies. And there are mainly two fears within their concern. One is the fear of double taxation by foreign subsidiaries, by foreign authority, and the other is the misuse of the confidential information by foreign subsidiaries. So it means that they distrust not only foreign authority, but also their colleague in foreign subsidiaries. And this is why Kei Danren set the CBCR as their prior issues of lobby. It is because they thought that this type of concerns is not necessarily represented by Western business. That is why they decided to lobby by themselves. And Kei Danren's fundamental stance on the CBCR is simply enough, that is unnecessary. This statement was perhaps the strongest opposition to the CBCR among other business groups. Meanwhile, Kei Danren also gave some proposals if they said it were to be unavoidable. Firstly, that the mechanism to exchange CBCR should be under tax treaties. And secondly, that the range of exchange informations of the data of CBCR, should be limited. As a result, as you all know, these opinions were partly reflected into the final result of the BEPS. It is indeed successfully for the business, but disappointingly for the tax justice campaigners. And as for the Kei Danren's lobbying strategies, it can be characterized in two ways. It's international and domestic rules. At international level, their way was on direct inputs to the CFA, as well as on indirect lobbying by exchanging views with BIAC and the OECD's CTPA, by establishing new annual dialogue with Pascal Santamans. And at national level, Kei Danren and its think tank regularly had meetings with officials of ministries. But this domestic approach also had an aspect of international lobby, since Japan was deeply positioned in the negotiation of the BEPS project as a chair of the OECD's CFA. Who was he? And he was Masatsuga Asakawa, the Vice Minister of Finance for International Affairs of Ministry of Finance of Japan, had been inaugurated the chair from the very establishing period to the final report of the BEPS project. And he testified in an interview that is published in Japanese that almost all of basic lines, directions of the BEPS project was agreed at the very first meeting with the other bureau members in October 2011. It was 4 months before that Pascal Santamans was being in office of the CTPA. So in that sense, Santamans is always highlighted as the champion of the BEPS project. And it is true, but it is also true that the basic line of the project had been already determined by the bureau members before he came in. Under the Japanese chairmanship, the Kei Danren took some advantages. One is that Kei Danren was able to get latest information of the project in a timely manner, because many Japanese officials joined the working parties under the CFA in order to support their boss, Asakawa. And the other aspect which might affect stakeholders' lobby was the reform of decision-making at the CFA, led by Japan and the other bureau members. This story on the reform is well described by Asakawa himself in several interviews published in Japan. And that is, from the bottom-up approach, which the CFA endorses the discussion results raised by each working groups, to the top-down approach, which the Bureau instructs each working group to discuss specific issue. So this reform had several implications. One is that the draft discussion papers were open in public, even remaining disagreements among Bureau Plus members. It is in order to accelerate the speed of the negotiation process and consequently to accomplish the project until the deadline set by the Bureau until during the Asakawa's terms. And this newly top-down approach, I think, offered stakeholders more lobbying opportunities, thereby allowing them to lead the contested discussions up to their favorable directions through lobbying to each national government. Of course, this consequence is not special to Keidanren, but widely relevant to all stakeholders. But in Japanese context, there is no such powerful lobbyists or civil organizations to involve effectively to the process. So Keidanren enjoy the opportunities that enable them to involve in the process effectively. So in sum, all of the approaches of Keidanren's business lobby can be shown as this diagram, whereas Keidanren took direct approach to the OECD by submitting comments and so on. Many other approaches of their lobby go through domestic path. To conclude, this research explored that Keidanren, a business lobby that is motivated not necessarily for aggressive tax planning, but motivated for avoiding unreasonable double taxation, acted as an enabler that made the rule for further tax transparency watered down. So we may call their role as indirect or unintended enabler. It will need further analysis whether and how interest of Keidanren for avoiding unreasonable taxing can be resolved. However, it may be worthwhile to think to separate the motivations of that the less aggressive from more aggressive ones in tax planning, because at least the former, the less aggressive tax planner, has been forced to be in disadvantageous international tax competitive market. So in this sense, the less aggressive tax planner, find by themselves the more transparency, the more useful for their global business, because their concern for unreasonable double taxation can be resolved by CBCR, or more specifically by public CBCR. So another point is, taking Japanese context, the Keidanren is only non-state actor in Japan which actively involved in the process of the BEPS project. So to this business body, and putting together with the efforts of Japanese officials, it is sometimes evaluated in Japan that the BEPS project had been widely supported by all Japan effort. However, this all Japan effort is not all at all. Because there were less diversified less diversified stakeholders involved, notably Japanese labor or civil society organization, were absent in the negotiation process. So in other words, Japanese business could be more influential because of the silence of the civil society. So this less public awareness is partly derived from the gender recognition among citizens, not Japanese, less aggressive to tax planning. In this context, I think Japanese civil society, and especially the Tax Justice Network Japan, established in 2017, is expected to play a leading role for a campaign as well as for further research on the behaviors of Japanese multinationals. There is a long way to go, I believe, but there must be a lot of cultural or societal barriers, but civic involvement can be a game changer. Thank you very much for your attention.
Thank you, Kumiko. I am tempted to suggest that we take 10 minutes and address these three presentations before we go to Marcus. So maybe there's no slide. If you help me with... Okay, so if there's questions, whilst we look at Slido.
I think while we are getting organized with the questions, I would just like to make a comment in support of Kumiko-san's excellent presentation about Japan, because I think it can really be a case study for us in the tax justice community, because Japan is a perfect example of a country with very high tax rates, both corporate, individual, and VAT, which is almost double the US tax rates. It has a non-aggressive tax culture. In other words, companies are not pushing for aggressive tax positions. It is a very stable society with minimal crime rate and minimal inequality. It has amazing safety nets in everybody having an option for an education at the public expense and almost free health care. So I think the model that Kumiko-san has presented, and which was validated by my experience in Japan for 23 years, working as a partner with PwC, I had unceasing respect for what a country can achieve if they continue to keep the tax rate at a level that is reasonable, and in Japan it is high, and still provide all the safety nets without creating an egregious culture of aggressiveness to counter it. And I think if I'm so glad you are participating in this conference, Kumiko-san, because I think we in TJN can learn a lot from the Japanese experience, because in a way that can be a model for all of us. In fact, my biggest problem as a partner in Japan was the constant pressure for aggressive positions by American and British companies for their expatriates on what they could or could not do. And after a while, I had to lose clients. I got tired of saying no, and got a reputation as somebody who was very difficult in dealing with this. But I still needed to do it even more so because I was operating in a society that had a culture of compliance and culture of respect for the revenue that is due to the government, as a result of which they can provide an excellent safety net for all its citizens without exception. So I want to thank you for what you've done and point out to our group what an example your country is to all of us.
Thank you very much.
Hi, it's a question for Kumiko as well. Your demonstration of how lobbying was done was very clear. What I'm less clear about is what have they achieved at the end? Is there any evidence that some of the key demand they were asking has been finally given at the end? I mean, is there any evidence that they went somewhere at the end and achieved something?
Well, thank you very much for your question. And that point on to what extent the Japanese lobby successfully affected to the result is not so much focus on my research, unfortunately, because it will need further analysis of the comparative analysis. But at least through my interviews or reading some resources in public, in online, that they're very keen to set their prior actions, especially on CBCR, via BIAC, based on the recognitions that BIAC or other Western companies is not necessarily represented those concerns. So they just tried to set their concerns into the BIAC's agenda. But the proof will be much more needed with those comparative analysis. So I would like to request each of you to those comparative analysis for further research.
Okay. Can I do two on the Slido and come back to you? So, one to Amedeo. Does the OECD achieve the results to create a tax network useful to all countries, including developing countries? Should the UN have a greater role? And after that, to Saskia, should TJN go further in framing tax wars or laws? Tax wars as deliberate actions, okay, to undermine the national tax sovereignty of less powerful state parties. So Amedeo first.
So thank you for the very interesting question. I believe that in general, every effort in combating harmful tax avoidance is absolutely appreciated. And generally, the point of the UN is very interesting because it's true that the involvement of the countries is major in that case. The point of the paper, though, is still to enlarge, not only to remain to the intergovernmental cooperation, but to enlarge also to the epistemic communities. So not stick to OECD or UN, but enlarge the debate to all the communities that can improve the dialogue and that can give us contribution and ideas that I think that Saskia really showed us how that this can be done.
I guess there's two parts of this question. The first, I'd argue, is that I think as far as my understanding goes, the current global tax governance system does affect lower income countries to a greater magnitude than it does higher income countries. So in that regard, it does undermine the national tax sovereignty of less powerful states more strongly than it does the others. But as for framing it as something deliberate, I think that's up for debate. But certainly the fact that we don't have a system that sets a minimal corporate tax rate, sort of like a multilateral agreement, is extremely damaging. And the refusal of states to consider it is, I would say, like, well, you could describe that as a deliberate action to undermine national tax sovereignty. So yeah, maybe I'll go with a yes for that one.
Does it work now? Okay. Yeah. I forgot to. So I'm Lauri Schöner from University of Helsinki. Thank you very much for the interesting presentation. My question goes to Kumiko about the Japanese tax system. In Finland, 2 years ago, there was a discussion over this kind of specific case about a Japanese corporation that had a subsidiary in Finland, and it was sold by a Finnish holding company. Usually this kind of capital gains from this kind of sales are tax exempt in Finland, but everyone was surprised that the company paid like 700 million of tax for the profits in Finland. And it was supposed that the reason was actually the Japanese controlled foreign company rules. So if the Finnish company hadn't paid tax for the capital gains, the Japanese controlled foreign company rules would have been applied to the sale, and they would have paid even more tax since the tax rate in Japan was higher. In this case, kind of the Japanese controlled foreign company rules made aggressive tax planning unuseful for Japanese corporations. So maybe this might be, what do you think, is this the reason why probably the Japanese corporations, do I understand the controlled foreign company rule in Japan correctly, and is this the reason? And I think this is very important question since the OECD, the new recommendations for digital taxation, one of the proposals is based on actually this minimal tax rules, which is based on controlled foreign company rules. So this might be one way of actually tackling. If each country had this effective controlled foreign company rules, it would tackle actually the tax avoidance everywhere. It might work in Japan.
Thank you very much for your comments and questions. But I'm sorry that I don't have not so much on the specific rules on CFC rules. But I assume that basic concerns of Japanese business and Japanese institution rules is based on the fears that Japanese business tends to be targeted by the more aggressive tax planning by the Western or other countries' business. So basically, Japan and Japanese business is keen to establish, even in the BEPS project, to establish the rules for preventing double taxation. So they don't have kind of effective rules or strategies to survive international competitive tax markets. So I'm not sure my answer is useful for you, but I would love to hear about the story in details from you. But the basic lines of the Japan and Japanese business is just stick to the further prevention for the double taxation.
Kumiko, just a question. So on the one hand, I mean, Christian's point about we can learn a lot from Japan's, domestic tax policy. On the other hand, you were also saying the reason why they're investing a lot in China is partly because they are taking refuge in China. They're trying to use Chinese laws to reduce exposure to competitors and also tax. So the two things don't seem to, so their behavior in the country and their behavior externally are different. So where do we square the brackets in that? And then my second question with that was also, what can we learn from the way that the association, CADA ran? How they managed to successfully, basically, in multiple ways, influence the BEPS negotiation. What lesson does it teach the tax community? What could we do better? How can we learn from that?
Thanks, Charles. On the first point, I totally agree with your opinions that there are huge gaps in their behaviors in the domestic and the foreign subsidiaries, and that is what we have to tackle on to ask for to reform for further improvements of their behaviors. And I'm not sure it is relevant. That all I know is that on the activities in Chinese markets, they're just afraid of that double taxation, unreasonable taxation are there, getting more and more severely, and I'm not sure it is true, but they recognize that it is partly because of the local Chinese authority is motivated by the achievements, pursuing the achievement of their quota. So they just feel that it is unreasonable. So that kind of the behaviors is so much motivations of the Japanese companies, but it is not to behave so. I think it is not fair that just doing criticizing Chinese markets, whereas they just only protecting their own profits. So I'm not sure what the solutions to small to decrease those gaps, but at least we have to recognize that those kinds of feelings or sentiments are there among Japanese business. And on the second point is on the lessons learned from the Japanese business, and it is very tough questions, but for them, it is a kind of successful story that finally Japan come to the stage of level playing field of international negotiations, because Japan is often criticized that they just do what the US do. So, but to improve situations, ironically, the situation is going bad, I think. So we have to find some more constructive ways of solutions to find the balance that to achieve the appearance of Japan in international negotiations, but it must be much more fairer negotiation and results for further international global tax justice.
Charles, if I can add to very good reply. If I can just add to your question about how we square the two. I think in answer to your question, Charles, about what can we learn, the fact is that Japan's tax rules are principle-based and not necessarily rules-based on every circumstance. The spirit of the law in terms of what is intended here on any transaction is outlined in a very precise way rather than the details as to the implementation. I'll give you an example. The reason why Japanese companies don't extensively use tax havens is because the law says if you are in a low or no tax jurisdiction, you have to establish why having a subsidiary there is necessary if the work can be done at the headquarters in Japan. Unless you have moved physically the management of the company, unless you have sales and distribution centers over there, unless you have substantial bona fide presence, only then will we allow it. Otherwise, we will not. So most Japanese companies cannot meet that in principle requirement, and therefore they are very hesitant to use it because it would be disallowed. So as a result, the use by Japanese companies of these tax havens is minimal because goes against the principle that is outlined in the Japanese rules. Now, if you look at the American tax code and the American regulations, you compare it to the Japanese tax code and the regulations, they are much less extensive. It's partly because of the principle base. That's my reading. Others may have a different view. The China question, I would say, my experience with that was that the Chinese tax authorities were very aggressive in going after all kinds of companies, whether American, British, Japanese, or others. So Japanese companies had to be quite defensive in their tax postures in those countries, and they were using extensively lawyers and accounting firms to do what was right, quote unquote, in China, knowing that irrespective of what they did, they would be attacked. So it was not like they were creating loopholes per se, but they were trying to deal with a culture in which the tax authorities would be adversarial as a first line of defense, which made them, and since they're very publicity conscious and reputational conscious, made them careful about what they could or could not do.
Thank you very much.
Anyone on the audience before I go back to a few questions on Slido? Okay. So Amadeo, does the OECD, because you,
Oh, no, this one.
that one has been answered.
The last one, probably.
So, so this is the last one now. Okay. Is there not the risk that the enhanced reliance on these epistemic nets give more power to the historically more powerful voices?
So I fully see the concern here, and I believe this is very important to answer this question for this reason. And I will answer with 2 points. The first point is that we see this enhancement as a defensive measure against unfair tax competition. So it would be counterintuitive to have defensive measures against tax competition, which is a state interest, and go at the same time and give at the same time power to these voices. And the second point instead is that I believe, and this is my belief, this is not expressed in the paper, that those historically powerful voices are already there, and they're probably already influential. So I believe that giving voice to epistemic nets is a way to enlarge the debate that is probably already full of the historically powerful voices. And then epistemics, we chose this expression because it refers to knowledge. So I believe that knowledge will be welcome anyways in this debate. Thank you.
Okay, so I think we should move to the last presentation. I think it follows very nicely on Saskia's point that ideas have power. And if we learn from what corporations have done, I think we are on our way as well, setting the norms, imposing our own interpretation of values and lives, and setting the context for the debate. So,
thank you.
Marcus.
Now it's better? Okay. So I'm standing here, but that's a very broad team effort. So I'm having a double act with Leila, but still there's many more people who are involved in this. I will run through this because a lot of ground to cover, and I want to focus on 2 results and a bit of the methodology of this. And Leila will present one type of the results that we want to focus on today. The Corporate Tax Haven Index, CTHI, ranks countries by their contribution to global corporate tax avoidance risks. And it complements the Financial Secrecy Index, which is more focused on individuals and on the broader set of concerns far beyond tax. The CTHI is focused on multinationals tax avoidance, and it's covering at the moment 64 countries. It is constructed in a similar way than the STFSI is. It has two components, one haven score and the global scale weight. The haven score is a measure of intensity of how much a country is enabling and how aggressive a country is enabling corporate tax avoidance. It ranges from indicators you can see on the left-hand side chart, ranges from issues such as tax holidays and economic zones up to controlled foreign company rules. And we are grouping these 20 indicators into 5 categories, which are equally weighted. The 5 categories are the ones that we want to talk about. I want to focus on the results. The LACIT is the lowest available corporate income tax rate. The first category. The second is loopholes and gaps, transparency, anti-avoidance. That's the other one where we are going to focus on in the results, and then double tax treaty aggressiveness. If you paid attention in the first session, my colleague Lucas presented some of the results from that last indicator in the very opening session. This is combined then with a measure of extensity, how much is a country actually used by multinationals. We use a proxy. As a proxy, we are using bilateral FDI stocks reported by the IMF. We construct a global total of that, and we use a country's share of the total as the global scale weight. We combine those two data sets in the same way we combine the financial secrecy index data sets. And we arrive at an overall ranking. Now let me say a few words about the LACIT, the first type of category and indicator that I want to focus the results on later on. We have seen a number of the presentations, I think I counted 4 at least, in the last 2 days that had charts or graphs of corporate income tax rates and how they were falling over the last years, that they were used by a number of people. Everybody that works with those data sets probably knows about the constraints these data sets are having. They are often relying on OECD data sets. It's the top statutory corporate income tax rate that is mainly used. They are often very misleading. Take the example of Malta. Malta is often reported as a 35% CIT rate country, but it has enshrined in law automatic reimbursement of that corporate income tax paid if it's paid out to shareholders. So you get back the tax that you already paid. So it's a 6/7 is reimbursed. So we actually use for the LACIT, we use a 5% rate instead of the 35% rate. And this is where we have 11 adjustments for that lowest corporate income tax rate that we are proposing. I want just to explain maybe the most controversial ones, maybe just focus on the step 3 in this slightly complicated looking chart. The first one I already mentioned, we disregard distribution or retention of profits. Estonia or Latvia are the opposite of Malta. They only tax if it's distributed. Then there's adjustments for the type of company. The Swiss holding regimes are falling into this, but also Montserrat still has an IBC regime that exempts the IBCs from the normal, otherwise applicable taxes. Territoriality, for example, Hong Kong does not tax active business income from outside of Hong Kong, which there's academic evidence, articles that show how this is actually used by Canadian corporations investing in China to avoid any taxation for their Chinese profits. And the fourth adjustment we are making is the unilateral tax rulings. This is where we have in-depth investigations by the European Commission into state aid cases where, for example, Apple and Starbucks, etc., were shown and in-depth analyzed and documented with a lot of paper and charts and calculations in how they paid not 15 or 25 or 30% of tax, but only 0.02 or whatever percentage of tax. We are using that tax ruling data on the ground that we assume that other multinationals are able to access a similar low tax rate against the background of all the countries not having backtracked from those rulings. They're still providing those, and they are even fighting it at court. So now let's move to some research findings. The top rankings, these were hopefully seen by you in the media or elsewhere. The top 3 countries highlighted in blue here is every country controlled by the UK. The top 3 countries are BVI, Bermuda and Cayman Islands, or UK-controlled satellite corporate tax havens. And the next 3 are European countries. The next chart, if you maybe, oh sorry, this is very hard to read, but the blue color should do the trick. It's the same coding. The blue color indicates controlling by UK, controlled territories, and the right chart is basically a ranking not by the corporate tax haven index value, by the combined value, but only by the haven score. So only by the intensity of the aggressiveness of a country's policies. And you see that out of the top 10 countries, you have 8 which are British controlled. If we now take into consideration that the top 10 have an average, the top 10 on the left-hand side, the top 10 countries that are also in that ranking, the top 10 combine a 40% of the global total foreign direct investment that is recorded by the IMF. And those top 10 countries have all corporate income tax rates, as defined by our LACIT, of 3% or lower. You can see how broken our corporate tax system globally is at the moment. Now, a few more results on the LACIT. This is just the gray dotted columns are basically the top statutory rates. You see here the greatest discrepancy for Netherlands and Switzerland, Luxembourg, Singapore, and Hong Kong. You can see that the actual LACIT that we calculated, these are the colored charts for Netherlands and Switzerland, are at 2 and 3%, and for the rest of the top 10, they are 0, basically. Now you can do a lot of interesting charts, tell a lot of interesting stories for the different categories. For example, this is for the loopholes and gaps. You can see how each country is comparing against the best performer, etc. You can do this, and we only want to do this with anti-avoidance rules now, which at what point I hand over to Leila.
Thank you, Marcus. And base erosion and profit shifting policies require implementation through unilateral actions such as domestic legislation or administrative regulations, and or bilateral or multilateral actions via international treaties. Under the anti-avoidance group, we examined unilateral actions taken. The group consists of 5 indicators. First 3 are deduction limitation for 3 types of payment scenario, i.e. interest, royalty, and service payments. And fourth one is withholding tax for dividends, and the fifth one is controlled foreign company rules. When we look at the graph, we see that Europe performs better than Africa in deduction limitation for interest and service payments. Meanwhile, Europe performs worse than the OECD average in controlled foreign company rules. As a matter of fact, the EU countries had to transpose CFC rules because of the anti-tax avoidance directives shortly added. And 15 out of 28 member states hadn't had any CFC rules before the ATAT. And now they all have CFC rules. Then why their performance is low? Because the ATAT introduced 2 options for the sake of flexibility. One is weak and the other one is strong. And several member states introduced weak rules and lowered the average of Europe. When we collectively consider unilateral measures recently taken, the corporate tax haven index indicates a tendency towards unilateral action that goes beyond the OECD BEPS project. And look at the US example. And US new reform has introduced the BEAT under the basic mechanism of new measure. The certain deductible payments to foreign affiliates, such as royalty, interest, and service payments, are added back to the taxable income. And the modified taxable income is subject to BEAT. And Poland and Greece have introduced a service payment limitation as well as royalty payment limitation similar to Austria and Germany, South Africa, and Tanzania. And Netherlands, they are planning to introduce a withholding tax on interest as well as royalty as of 2021. However, the corporate tax haven index also shows us how exception weaken these unilateral actions. Even if 48% of index countries have introduced a fixed ratio rule to limit interest payment, to limit cross-border interest payments, the corporate tax haven index shows that 81% of them weakened those measures by creating loopholes via a group ratio rule and or a financial undertaking exclusion. So in sum, when we compare all 5 corporate tax haven categories, Europe has much work to do since it is the worst performer in 3 of 5 categories. When looking at best performance scores, we see that the greatest distance from ideal score are in transparency category, indicating that in this category most policy innovation is needed and or courage of first movers is needed. So if you go to the corporate tax haven index website, you will see the full ranking and summary reports. And moreover, technical reports of individual countries are available in open data format. So thank you for listening.
Any questions regarding anything, methodology, findings, application? It's like, yes, please.
Okay, my question is to Marcus and Leila about the LACET. So for example, like I just want to make sure like I'm understanding it properly. So for example, if a country has a free zone that offers like 0% tax to a specific industry, or like, you know, you have like lots of countries have like, you know, technology parks where they give tax incentives to like, you know, digital companies or any other industry. Would that qualify as a LACET basically? Because then I would imagine that most countries would have like, you know, at least one industry or one type of activity that is tax exempt.
Should I answer straight away? So that's a very good question. The economic zones and temporary tax holidays were not spilling over into LACET as long as economic zones are regionally confined and are basically contained. They are captured in the indicator 6 only. But if you have broad sectorial exemptions, an entire economic sector is exempt, then we had drawn a line at 4 sectors out of 13. We have sort of classified all the incentives and all the concessions in tax, the lower tax rates for 13 economic sectors, the maximum. And if you have 4 or more broad sector exempts, then it would be counted in LACET as that rate, that lowest rate that is available there, but not the economic zones ones.
There's nothing in Slido. Okay, so I think we probably have enough for the day. So one more round of applause for the presenters. And see you in the pub.
We haven't told them about the pub. All right, I'm not going to keep you, but I have a few bits of housekeeping and 1 or 2 things about next year to say. But first of all, I need to say thank you to City for providing us once again with this fantastic venue and all of the work that goes into making this possible. Has Ronan's there? Okay. Really, no, and thank you, and Anastasia, really, it's fantastic. And Prem, who sadly can't be here, but would have liked to be here, and all the support we get from the AABA. In terms of the people who are, some in this room and some not in this room, who've really made this possible, the whole team at TJN, but particularly Faria, Will, Mark, Naomi, James and Madeline have really made all the things that have been terribly smooth work. So a big thank you to all of them. They include the people who will make sure that slides and papers and videos are online pretty soon, no pressure, so you can find everything there. Next year, we plan to be in Senegal, probably in June, with Tax Justice Network Africa and FES supporting. That'll be confirmed soon, and I hope you'll join us again then. By the time we meet next year, there will only be 6 months left of the 18-month OECD work programme on the international tax rules. That may mean that we are very close for the first time to having a formal apportionment basis agreed as part of the international tax rules, or it may mean that it's been struck off. Now, John raised with me earlier that it is too far away to wait for Senegal, never mind London again in 21, to focus our efforts on that. At the minute, a whole set of countries and the OECD and various researchers are scrabbling to put numbers on what it would mean for countries' tax bases if we switch to an apportionment basis. So we are discussing now holding something like a one-day workshop towards the end of this year to bring together as much additional new research as we can on those numbers. People like Dan, who have put together some new numbers in the area of FDI, I'm going to be coming to bother about how we can turn that, but also Ronan and the work that his team are doing on CorpLink, thinking about how we can bring new approaches to the apportionment problem, given the lack of data that we still have, and building, of course, on the presentation from Sol last night, the contribution of Alpi Fitzgerald in thinking about different ways that apportionment can be applied. So please get in touch with us if you have thoughts on that. Right, last things. Downstairs there are sandwiches. Please do not waste them. They are in boxes ready for you to take, either to take with you or to give to homeless people as you make your own way home. Or indeed to the peasant at 240 St. John's Street, which is basically going out the door, turning right, go to the main road, and about 2 minutes down the road to the left, and you will find a fair few tax justice people in the pub. And that, you will be glad to hear, is that. Thank you all for your contribution, and please go well.